Chapter 7, Part 1, we're going to look at cash, trade, and sales discounts and go through an example. Now, we have cash and cash equivalents. Cash is our most liquid. Cash equivalents are short-term investments that are highly liquid and easily converted to cash less than 3 months, also called trading securities. Now, we also have restricted cash. Is regular cash and set aside for specific purposes will appear as a long-term investment on the balance sheet. Now, bank overdrafts. Under GAAP, overdrafts can be offset against other accounts if they are in the same bank. Otherwise, they must be treated as a current liability. Now, under the international standard, you can just take all of your accounts and offset them, regardless of what bank they're in. So let's take a look at this example, and we're going to first record it under GAAP. So in this case, we have a balance of $250,000 at the right bank with an overdraft of $10,000 at the same bank. In addition, they have a cash balance of $50,000 with Wells Fargo and an overdraft of $10,000 with Citibank and an overdraft of $5,000 at Low Bank. So how would this appear on the balance sheet? Well, for cash, we'd have $290,000, which would be the $250 plus the $50,000 in another bank less the overdraft in the same bank as the $250. And then under current liabilities, we would have $15,000, which is the overdraft at Citibank and the overdraft at Low Bank. Now, under the international standard, we could just offset them together and get a total current asset of $275. And we would have no liabilities. Now, trade discounts are ignored. A trade discount is if they say something costs $100, but if you buy 10 of them, they only cost $90 each. Excuse me. Now, a sales discount is given for early payment. We have the gross method, which you record the sales and record the discount if taken as a debt to sales discounts. And then we have the net method. We book sales net of the discount and credit sales discount forfeited, an adjunct account to sales when discount is not taken. So here we go. Under the gross method, we had company had a list price. They bought something with a list price of $62.50, but they got 20% as a trade discount. So this is what it would look like. We would show the $5,000 at the point of sale, and we paid within terms. So we'd have a sales discount of $5,000 times 3%, because that account within terms 310 net 30 means you get 3% off if you pay within 10 days, but you have to pay the balance in 30. So if they paid after 10 days, that's what it would look like. Now let's take a look at the net method. The net method, what we do is we're going to take the discount off up front. So we're only going to book sales revenue of $48.50. Now, if they pay within terms, it's going to be cash $48.50, accounts receivable $48.50. But what happens if they don't? Well, they're going to have cash of $5,000. They're going to have accounts receivable of $48.50, and they're going to have sales discount forfeited of $150. Now, what about sales returns? Merchandise is returned for a refund or for credit to be applied to other purchases. Special price reductions. Maybe we say to somebody, hey, if you pay us early, we'll give you 5% off. Or we would rather if somebody wants to return the merchandise, what you might say is, okay, we'll give you 50% off if you just keep it. That's what a sales allowance is. Now, how do we handle sales returns? what we do is we accrue sales, returns, and allowances at the time of the sale and adjust at year end. And the reason we do that is if we recognize sales returns when they occur, this could result in overstated income in the period of the sale and understating income in the return period. So let's take a look at an example. Here we have ABC Company allows its customers to return merchandise for any reason up to 120 days after delivery and receive a credit to their account. All of their sales are on credit. The company began 2024 with a balance in their refund liability account of $300,000. During 2024, they sold merchandise of $15 million, and their cost of goods sold is 75% of sales. Also, during the year, the customer returned $500,000 in sales for credit, with $225,000 of these being returns of merchandise sold prior to 2024, and the rest being merchandise sold during 2024. Sales returns is estimated at 3% of sales. So what information do we need? We need to know what our beginning balance is in refund liability. We need to know the amount of sales, the cost of the goods, how much was returned, how much related to prior year, and we need to know what we estimate sales returns to be percentage. So we have to book the actual returns of $500,000. Well, we know $225,000 should go against the reserve, the refund liability account. But we also have to make sure we do the cost of goods sold, because we have to take that out too. Now we have to record the amount that applies toward actual sales, which is $275,000. So we do sales returns of $275,000 and accounts receivable is reduced. And then we do inventory and we do cost of goods sold. Now, what is the adjustment for refund liability and inventory estimated returns at year-end based on 3% of sales? Well, first we have to take our $15 million in sales times 3%. Then we have to back out the current year returns. So it tells us the ending balance in refund liability should be $175,000. We take out the current balance of $75,000, which means we have to do a journal entry for sales returns of $100,000 and refund liability of $100,000, which gives us the $175,000 and ending balance that we asked for. Which is this number right here. And now we have our total sales returns for the year of $375,000. Now we have to also adjust inventory estimated returns. So what we're going to do is we take the $175,000 and we take that times 75% because that's what we know is our cost of goods sold, and it gives us $131,000. We subtract out the current balance of $56,250 that tells us what adjustment we have to make. So there's our journal entry, and it gets us our $131,250, which is the number we are looking for. And that ends this presentation.